right, welcome back, everybody. BlackRock out with quarterly results this morning. Larry Fink is here. He's the chairman and the CEO, and he joins us right now. And Larry, it's great to see you this morning.
Good to see everyone. Good morning.
You came in with earnings that were better than expected, $7.15 a share versus the $6.96 that the street was looking for. What happened?
I think it's the same consistent theme that I was been talking about for years. Clients are moving away from products. They're looking for solutions. They're looking for an investment firm that can provide them a holistic approach to their needs. So we raised $84 billion. What's more impressive to me, at least, was over the last 12 months, we raised $350 billion. And it was across the board from fixed income. Even in parts of active equities, we raised money last year, especially in the retail side. Illiquid alternatives, we raised another $5 billion, which in the quarter, and that puts us around $46 billion over the last 3 years. Our cash organization is now crossed over $500 billion. And so across the board, we have been penetrating more clients with deeper relationships, more holistic solutions. And I think it's just showing up in so many ways.
Are they clients that are new to Wall Street, or are you taking clients from other places, people who used to be at other firms?
I think we're winning market share unquestionably. And probably the most important thing over the years is clients are now awarding us more and more of their portfolio. It was announced in Europe a few days ago that we are going to be responsible for managing over $50 billion for Rabobank. That's coming, the announcement just occurred. And it's just that holistic solution that where we're helping them, we're educating their distribution parts of their firm, we're working with them, we're providing investment technology.
So who was managing that kind of money for them, for example, before?
It was in-house.
It was all in-house?
That was in-house, in that example. But in other examples, they're looking to go from 6 managers to 2. I think what more organizations are finding out, having dozens of investment firms have not proven them to have them receive higher alpha. And they're looking for more concentrated organizations who could do more for them.
Larry, it's been a pretty uncertain time in the markets.
Yeah.
People watching everything that's happened with the trade talks here, with Brexit, with an economic slowdown happening, and we're looking at markets that haven't really gone anywhere for a year at this point. What do you think when you look around?
Well, U.S. equities are up quite considerably.
This year to date, but not
year to date.
not full
but
year.
not over 12 months, it's about
12
flat.
months, right.
Yeah. But
that's
on the other,
a big dive.
I mean, a great example of what's going on in the market, though, in the third quarter, U.S. equities up 3%, but emerging markets down 3%. So, I mean, a 6% divergence is pretty significant.
Right.
Well, we have central banks that are resuming quantitative easing. Even our central bank, the Federal Reserve, is now buying short-term instruments. They don't want to call it quantitative easing. It is quantitative easing,
right?
And so they're buying more instruments. So we have a very supportive central bank regime worldwide. U.S. growth is at least 2%. China growth is somewhere between 5.8 and 6.2. Despite we're paying so much attention to the political and geopolitical issues that we're losing sight that the world still is moving forward. And so I think that's one of the big issues that's going on now. It's not great, but it's not as bad as we feel every morning we wake up.
You know, we just talked about a Bill Gross call where he said all of these negative interest rates around the globe, $17 trillion worth of it, he thinks that that's going to put a real limit on the amount of upside that you see to equities, because he said in the past a strong equity market has been tied to real low rates, and there's too much other things that are happening. I mean, I kind of look at it as the opposite, where if you have negative interest rates and you're paying somebody to hold your money in bonds, it definitely makes equities look more attractive by comparison.
I understand your point, and your point is well taken. What I believe the problem is the transmission of negative rates. So in Europe and Japan, where we have negative rates, they don't have a mortgage market. Most consumers there own their home. If they own their home, they own it in total. They don't have a mortgage. Mm-hmm. And because of that, you don't see the transmission from lower rates that translates into a lower mortgage rate, and the consumer gets $50.
Right.
So in Europe and Japan, I'm struggling with the concept of negative rates because you don't see that consumer transmission. In addition, you have the banks who are struggling with their net interest margin because of negative interest rates. They're not going to be out there lending and lending and lending. And so I don't believe negative rates and persistence negative rates translates into more economic activity. It may translate into a depressive element to the economy, especially in Europe and Japan, where 82% of savings is in a bank account. So they're not enjoying the success that Americans do with low or negative interest rates.
One of the things I wanted to ask you about was the IPO market and what that may say about the larger market. Obviously, this WeWork's deal that hasn't, the WeWork's IPO that wasn't, if you will, has the bell rung on the IPO market? What's happening here?
I think what the bell
does it say about where we are?
I'm not. It really says nothing about the IPO market. It says something about the private growth valuations.
Okay.
I think that's the bigger issue. This is why I believe in public markets. The public markets, it's harder to hide. Reality is shown every 3 months, and this is why having that public exposure and transparency is the best outcome for all companies to continuously
One of the things that's so
evolve.
interesting is firms like BlackRock, which historically invested solely in the public markets, now some public, typically what might be described as public market investors, are getting access through some of your funds to private markets.
That's true.
How should they think about that? Especially when you have situations like an Uber, which in the private market was valued one way and all of a sudden comes into the public market and falls.
It's a wake-up call for these private valuations. I mean, there was certainly way too much money flooding into the private growth valuations. And I think it's being reset. There was a mantra about growth at all costs. First of all, and I actually believe that is a bad culture that these companies are persisting. Because if you don't set a culture of building a company, long-term profitability, having a culture of only growth at all costs really produces bad outcomes in the long run. And I really do believe this reset in the private growth valuations. Hopefully the valuations are going to be more about the real operating concern. And so I think there's going to be a big reset on these valuations.
But what do you tell then your managers who've been buying into the private markets? You say them to lighten up, let's be more cautious, change our approach?
I think everybody, our investors and every investor needs to change their approach. They need to be much more thoughtful about when companies can make profits, and are these companies real or are they just being sustained by private capital? So I believe this dovetails into everything that goes on related to being a public company. There was this mantra, private companies were staying private longer. I think that's a bad outcome. I think you should be going public sooner, being part of it, to try to respond to that transparency. This is why I've been repeating the whole mantra of transparency is a very good ingredient to build a strong
But you don't think this is a
organization.
sign or a signal of something larger in the economy or in the markets writ large? Do people say this is, are we in 2000 or 2001, or is this 99, or because people sort of look at these things as economic indicators?
I think it's another negative, but that negative, I don't think it's that that will carry on throughout the whole economy. It is a negative, but I believe it can be moderated very quickly through this process. And I do believe this is not something that's going to be systemic, but it is a problem. And
Larry, you could make the point that it's cheap. Cheap money is everywhere. It's just another example of cheap
when you
money.
have negative interest rates and low interest rates, we're going to see.
Well, this is the malinvestment, perhaps, that everyone's worried about, and if we could be at the front end of figuring out where all the other malinvestment is, couldn't we?
Joe, I totally agree. There is no question, low and negative interest rates. The transmission of that produces bloated valuations. We saw that obviously in the credit markets in 07 and 06. We saw that in the growth equity market in 99 and 2000. So we're going to see those episodes again. But I don't believe for the size of our economy, the amount of capital went into the growth private capital is going to be something that's terribly systemic.
When you have looked historically at investing in election years, what do you think? Because there are a lot of people now that are looking at this election year, and historically, by the way,
Election year is next year.
well, election, yeah, but we're pretty much,
I understand.
we're pretty much there on a year-over-year basis,
Unfortunately,
almost.
yes, it's.
And no, and if you look, capital expenditures often go down because companies sort of sit on their hands waiting to see what's going to happen, depending on who you think is going to win.
Yeah, but I think that's changed. I think capital and capex has been moderating dramatically because of the uncertainty around trade. So I think there's other elements that are transcending, that are transcending whether it's an election year. I also believe the hyperbolic enthusiasm over the tax cut is now transcending into something different. A tax cut, I think I've said on this show, is a one-time event. Okay, if you have an 18% decline in your tax rate, which is below the line, not above the line,
Right.
It's a one-time event. The stock market is efficient. The stock price rallies to that point, and the PE stays constant. And thereafter that, if you start raising wages, if you do additional capex, it starts deteriorating your margins. And I think that's actually what's gone on a little bit. The enthusiasm of the tax cut, one-time boost, and now reality sets in. Should I spend more money on capex? Well, you know, a lot of people believe you'll have more profitability, but that's below the line, and people are forgetting how accounting works.
It sounded to me in the last block like you thought the market was not overvalued here, though, that you think that there are a lot of good things that are happening out there and the market's not necessarily reflecting that. Am I wrong to?
The market is properly valued overall. I don't see that many extremes. And that's because the central banks are going to be highly accommodative, at least for the coming year. What I worry about is more of 2021, after the elections, and where is the economy thereafter. But with the Federal Reserve, they have very little tools left, and they're continuing to use those tools. The ECB only has the tool of more QE. Hopefully, our new ECB president, Christine Lagarde, starts coercing, I hope, and I want to use that word, the politicians to start using fiscal policy, because I think that's a much better trend.
Bring it back home, Larry. Are you a banker that has Warren phobia or not?
I don't have, right now I have paid very little attention to the politics right now.
Who are you, Steve Kerr? Ask about China? You haven't thought about Elizabeth?
No, I haven't.
You have no idea Elizabeth Warren might be president, and you run the largest asset manager in the world.
Right
Hasn't even occurred to you.
No, I am not paying attention.
Haven't even thought about it. Have you heard of her?
Not much. I haven't.
Okay. All right, Steve. It's like
You may question that, but I really
you really haven't thought about what.
Not yet.
Your shareholders might appreciate it if you gave it some thought about whether there's a Warren presidency.
The election, I promise you I will. But until we see who are the candidates and what they really stand for after the primaries, I'll pay a lot more attention.
Okay.
Sorry you didn't like that answer.
No, I don't. I don't care.
The debates tonight.
I don't care.
Not.
You will not be watching the debates tonight. Okay.
Watching Jeopardy. Okay.
Larry Fink.
I'm taking my wife, out to dinner.
Fair enough.
Okay,
Good for you.
because I'm traveling starting tomorrow.
Enjoy.